Good afternoon and welcome to our first webinar of 2021. I'm Kathy Fettke, the co-CEO of Real Wealth Network. And wow, what a start to 2021. Woo! All right, I'm excited to give my predictions this year. I've been doing this every year for about 15 years now. And this year I've got a lot of slides that I'm excited to share with you. So I know we've got more people joining us. I'm just going to stall for a little bit. Let's see. As I'm stalling, I just want to say really Happy New Year. I already, what a day yesterday was. What a day yesterday was. And, you know, the US Constitution won and is solid, and I'm grateful for that. I'm grateful for you all at Real Wealth for being here today with us. And again, I'm excited to share my predictions. For those of you who don't know, basically I interview a lot of people on the Real Wealth Show. We have wonderful people like Rick Sharga of Realty Track that give us data, Doug Duncan of Fannie Mae. I just follow a lot of economists and experts in the industry and gather that data and a lot of news sources to put together what I see coming for the new year. And I'm not an economist. I'm a real estate investor. And of course, we have 4,000 members now at Real Wealth. We have a lot of real estate experts within our network. So we just have a lot of boots on the street that help me get real-time data to be able to share with you. So we'll go ahead and get started. Once again, welcome to Real Wealth Network. We have so many new members, and I'm so glad you could join me today for our 2021 housing market predictions. Let's get started. I want to let you know we have some upcoming webinars at Real Wealth. Next Tuesday, we have January 12th, Charlotte, North Carolina. We'll be focusing on that market and showing income properties there. That is a booming market. So really great to know what's going on there with the team from that market. And then Thursday, January 14th, we'll be talking about taxes, and this will be very important. There could be some changes now that we know who our president is and what kind of changes we might be looking at in taxes. So that's going to be very important for real estate investors and to find out how that might affect you. And then Thursday, the 21st, we'll be focusing on Cleveland, Ohio, and available properties there and what's going on there. If there's a shortage of inventory that there seems to be across the nation, if that's also happening in Cleveland, if we're seeing prices go up and cash flows as well. So check that out, Thursday, the 21st. So, and today I'm not really going to be talking so much about foreclosures because we really addressed that on December 30th webinar with Rick Sharga from Realty Track. And I highly recommend, if you missed that you go and check that out on our website. This is what it looks like. The outlook for 2021 is a little bit different than this forecast that I'm doing, because in this one we were really talking about distressed inventory and the possibility of foreclosures hitting the market and when that would happen and where. So you can look that up at realwealthnetwork.com to get the details on that. He's just a wealth of information. All right, and let's see what else. Disclaimer, just want to let you know that these are my ideas, so take what you will and throw out what you don't want. And the strategies I mentioned may or may not be appropriate for you. Other options may be better for you. Always consult with your accountant, and I really mean that. This is not just a disclaimer that our attorneys tell us to do, which it is, but really speak with your accountant, because every investment you make, anything you do in real estate is going to affect your taxes, and you need to know that before you do the deal. So definitely talk to your tax advisor and or attorney to go over contracts, and certainly in any syndications, just have an attorney review it. I can't tell you how important that is. Past performance is clearly no guarantee of future results, because the future is changing by the moment. As we know, 2020 certainly taught us that it's very hard to predict and know what to expect. I will say though, last year, if you watched my last year predictions for 2020, I said there would be most likely a black swan event. I didn't expect it to come in the next month, but There you have it. Real estate purchases are, of course, subject to investment risk. Every investment has a risk, and also the possibility of losing money. And it's important to know that going in, and that's why you want to make sure that you really do your due diligence beforehand. Always get an inspection report from a third party, licensed inspector, so that they can find things that maybe you didn't see. Always get that third party appraisal from a really good appraisal company that can tell you the value of your property, even if you live in the area. These are important things to do. So yes, and while every effort is made to maintain accurate and current information, there's always the possibility I could be wrong. So again, take what you want from my predictions, and certainly don't rely on them for your investment decisions. But I'm super happy to share what I learned from this process. Okay, so I am going to start with my story, and I'm just going to get off camera now so that the slides are bigger, and I'll see you in a bit. When at the end of the presentation, I'm going to take questions, and I'll come back on then. All right, so a little bit about my story, because again, we have a lot of new members who maybe don't know this about me. You'll see I started my career in the news. I worked at ABC7 in San Francisco. I worked at CNN office in San Francisco. I went to San Francisco State in broadcasting, and also worked at KTVU, Fox News in Oakland, and CTV in Pleasanton. That was my start. I was a news writer and sometimes reporter in those stations. Let's see, in 1997, when I married this guy, we bought this house. This was our first house. It was through my dad, who was in the middle of a 1031 exchange. This was way bigger than we could afford, but before we knew the term house hacking, we thought, well, it's a beautiful house, but even better, this little unit down here was an in-law unit, and this little unit was an office with a separate entrance. The in-law unit already had its own bathroom and its own kitchen, and so for the little office down here, it had a bathroom, so we put in a little kitchen, and we turned it into a triplex. And then later, so this just made this house affordable for us before we knew that house hacking was a thing. Now we got our tenants from Craigslist, so we learned a lot the hard way. It's much easier now. We also had friends living there sometimes, but it helped us make that mortgage payment. And over time, it was 97. So if you know about market cycles, that was the bottom. And that property went up about $100,000 every year after that. So quite a great investment. Right around then, let's see, in 2002, Rich came out with this book, Extreme Success. We were truly living it with this dream house, and we had 2 kids, and he had a really successful international coaching program where he coaching people on really increasing their business, but also improving their personal life, just a real well-rounded life, which if you didn't watch his webinars this year, be sure to do it. They're really life-changing. But at that time, right after his book came out, he went on a book tour. He was on national news all over the country, traveling, promoting this book that was published by Simon & Schuster. And when he came home for a break, he noticed a freckle that he hadn't noticed before, and he's a redhead, so he has a lot of freckles. But this one freckle stood out. Turns out it was melanoma, and the doctor misdiagnosed him, told him he had 6 months to live, which of course was shocking. Rich is healthy today, and he had the melanoma removed, and it did not actually spread the way the doctor thought. But in the time that we didn't know that, I started the Real Wealth Show, and that's when I learned, I was desperately trying to figure out what to do if the doctor was right, and if I would be a single mom with this huge mortgage payment and 2 kids, and basically I'd been a stay-at-home mom. I'd left my career in the news. So it was on the Real Wealth Show that I just desperately wanted to understand how to create passive income so I could continue to be a stay-at-home mom. And that's when I was able to interview, because I was on a major station in San Francisco, I was able to interview big names like Robert Kiyosaki. And it was Kiyosaki that you see in this picture that taught me. I think I had him on in 2004 and then again in 2005. And he was explaining what was going on with market cycles, and that California real estate, where I lived, was way overpriced, but there were other parts of the country that weren't. And so there's just really no one housing market. That was the big thing I learned. And that if you can really time it well, you can sell at the peak of one market and take that money and go invest in another market that's just taking off. So it was really through Kiyosaki and other experts like him that I had on the Real Wealth Show that got me on an airplane to Dallas, Texas, because basically Kiyosaki said he had sold everything in California and had reinvested it in Texas. And again, this was 2005, and like knowing that Dallas, Texas is a hot market is pretty common information today, but it really wasn't back then. Nobody was doing that. It was a boring market. Their prices hadn't gone up in years, and but what he knew is that the jobs were going there, and that real estate was still really cheap. So, we jumped on a plane, went to Dallas, because if it was good enough for Kiyosaki, it was good enough for me. And by the way, if you don't know who he is, he's the author of Rich Dad, Poor Dad, a book you should definitely read if you haven't yet. So when we got there, we found out that in this little town called Rockwall, we could buy a house like this for like anywhere between $120,000 and $150,000, which was absolutely shocking to us, coming from the San Francisco Bay Area, where this house, was going up 100,000 a year, to be able to buy this gorgeous house for 120 to 150,000 was just unbelievable. So we bought 5. Now, I was a mortgage broker at the time, so it's pretty easy for me to get financing. And it was, by the way, 0 down for investment property back then. Amazing. So yeah, why not buy 5? We did. And then we went back and bought like 5 more. That's how our career started. I talked about it on the Real Wealth Show. Had a lot of people say, wow, I want to know more. And that's when Real Wealth Network started, where, basically people wanted to know what Rich and I were doing. So we created Real Wealth Network to share our strategies and share our contacts in Dallas, and who we worked with and the property managers we were using. And that just continued to grow and grow, and that's what it is today. Now, right after that, again, this is a little bit more about me, and I'll move on to predictions very soon. Shortly after that, of course, the market did collapse, but not in Texas. And then we filled busloads of people to go into the foreclosure markets, buy those properties, fix them up, and really improve neighborhoods, while also really helping investors build their net worth, and also providing really affordable housing to people who lost their homes. So as a result, I got this award from Goldman Sachs at the Builders and Innovators Summit. I was one of the 100 most intriguing entrepreneurs. I won it in 2012 and 2013. This is me in Times Square for winning this award. And this guy is, this is a short and funny story, but when I showed up at the 3-day event that was basically celebrating these 100 most intriguing entrepreneurs, one of the people sitting at the table next to me was these guys who said, oh yeah, we started this thing where you can go on an app and get a ride. And I'm like, what's that? Oh, it's called Uber. So it's those kinds of people that were the other 100 most intriguing entrepreneurs. So I was mind blown why I was there. So when I got there, there was this guy in a suit who greeted me when they valeted my car. I got out, I was handed a glass of champagne, and these guys in suits were greeting me, and I was like, I don't know why I'm here. I said, it's Goldman Sachs award. It's funny because I've been blaming Goldman Sachs for the collapse, on my podcast. And then I looked up and I saw the person I was talking to was this guy, CEO of Goldman Sachs, Lloyd Blankfein. So I apologized quickly, and he just said, no, you're probably right. Anyway, so that was that award, which then led to, since it hit big news, I was then asked to be on lots of TV shows, and the big one was with Robert Schiller here on Fox News, where he was saying at the time in 2012 that he thought it was a very dangerous time to invest in real estate. And I was asked to debate him, and I said that's not, it couldn't be a better time. This is the greatest transfer of wealth in history, because we have hit bottom, and I gave all the facts, the low interest rates and the affordability. And by the end of that interview, he agreed with me. So I guess you could say that I won that interview, and San Francisco State won over Yale University. So I'm proud of my alma mater there. But that led to a lot more, and I've become somewhat of a voice for understanding where the housing market is, because it can be very confusing. And that's been exciting for me. So that's why I'm excited to share what I've studied with you today. Today, Real Wealth, we're still growing. We have 52,850 members. We've helped Real Wealth members get over $1 billion worth of assets. We have 821 free educational webinars on our website, and we have our Real Wealth Foundation where the 10% of our profits, which is about $513,000, has gone to our Real Wealth Foundation. So let's talk about traditional forecasting, and usually real estate agents will look at days on market to determine what's going on. Like if a house isn't selling or a lot of houses aren't selling and it's taking longer to sell, that becomes a concern, and you want to look at that. You start to see price increases or reductions, that can be a concern, and real estate agents want to look at that. If there's more cancellations, like, ooh, what's going on, you know? And then pending home sales, are they increasing or decreasing? These are just ways to figure out what's going on. Unfortunately, they are more retroactive than proactive because things have already changed and you're already kind of in a pickle by the time these things have happened. So you want to really be like, you don't want to put your house on the market just to find out it takes 3 months to sell it or 6 months to sell it because you didn't know what was happening. You didn't know that something would cause that, or that, you know, your price, you have to reduce your price because you got it wrong because you didn't see what was coming and so forth. So these are more retroactive, passive ways to understand what's going on. So there's a better way to really forecast what's coming, and it's more forward-looking forecasting. So one of the things, you know, we want to really be looking at is the demographic changes, jobs, supply versus demand, and fiscal stimulus. And this is the big one. The fiscal stimulus is really kind of new-ish since 2008, when the Fed just started printing money like crazy. There used to be a little bit of printing, now there's a lot of it, and that's really, really affected how you forecast, and at least how we do. So starting with kind of those things, let's look at the US population. We know it's growing. 1 birth every 9 seconds, 1 death every 10, 1 international migrant every net every 47 seconds. So a net gain of 1 person every 26 seconds. So we're at 330,791,000. Well, you got it. There's the number. So when you look at that, you can see that we're a country that's growing, and that is not the case for some other countries like Japan, where their population has been declining. So this is good for the economy. It's good for the housing for sure. Again, here is it just to show you that growth, and it's been pretty strong growth. You can see after 1990. We know that we had a huge recession, a housing recession, housing-related recession, you know, in 2009. And a lot of people like to compare today to then, but what they sometimes forget is this, that we have had about, I think right here it was, like 300 and something million. And so we have about 25 million more Americans from the last recession, and that needs to be accounted for when people get scared about that happening again, another housing recession. And when you really break that down, the population by age, you can see that we got some young people in this country, and that's really important for the health of a country. When you see in Japan and certain other countries in Europe that they're losing, that they're not having babies, and they're not having immigration, and it's they're not growing. And when you're not growing, well, who's going to, you know, who are the young people who are going to take the jobs and keep the economy strong and buy houses and all those things? So we do see that our greatest generation is, you know, they're over 90, and they are passing away. But you look at this Gen Z, 1-year-olds to 20-year-olds, and that's 86 million. That's a lot of people. That's a big generation. And you got millennials, age 21 to 38, and they are 82 million, another very large generation. Gen X, you got 65 million. Baby boomers moving down to 68, you know, because some are moving on. And then the silent generation. So we have a big population. And what's really interesting is that, look at this right here, these 2 lines. That's basically 27 and 28-year-olds. I believe I got that right. And I remember, or it might be 28 and 29, but my daughter is 28. And I remember when she was trying to get into soccer, and then she was, you know, just competing in different things and trying to get straight A's when there was a curve and then trying to get into college. It was really hard for her. There was so much competition. Well, this is why she was in the largest part of the millennial group. She had the most competition. So anyone who has 27 or 28-year-olds, you should be really proud of your kids for doing anything because they had a massive amount of competition. Getting into college, I'm proud of my kids for being able to do that when there was a lot of other people trying to do it. So this group is really, it's a wave. It's a wave that we have to be aware of, and they're just 28 years old. So how does that relate to what we're trying to say? Well, Harry Dent, you may have heard him on my podcast on the Real Wealth Show. I interviewed him, I think March of last year when we were first discovering the coronavirus, and he gave an incredibly accurate prediction on that show. He has this spending wave that he's kind of famous for, and such that the U.S. Census Bureau shares it. But basically, he says that the consumer life cycle is usually like this, where people in their 20s, they live in apartments. Then in their early 30s, they start to buy their homes. Then they need bigger homes for all their kids. Right around their 40s, they get bigger homes. Then they buy more furniture because maybe the kids are growing up and they have to get new furniture, or the kids have gone to college and they can finally get furniture they like because the kids won't ruin it. Then they got to be paying for college tuition and autos. And so there's this whole thing. Vacation, retirement homes happens in your 60s. You've got more, working with hospitals more when you're older. Cruise ships, I guess, when you're later in life, and more prescription drugs, and then of course nursing homes. So this is the spending wave. And so when you're looking at the wave of population, this is important to understand. So I took Harry's spending wave and I put it on that other chart on the millennials, and here's those 28-year-olds right here. So you can see they're still kind of in the apartment but they're starting to, I wonder if this actually moved. I didn't mean for it to move. It's supposed to be to the right. So I almost got this right. So just imagine that this has moved to the right a little bit. Oh, I know why. My husband came in, and I'm going to blame it on Rich. He came and cleaned it up. Anyway, this is supposed to be moved to the right. But what's important to see here is that you've got this wave of young people who've been living in apartments, but they're ready to buy those homes. And they may be a little bit later than, they say that millennials have been later to buying, but it's not really the case. They were just young. The largest group of them are 28. So we already know that in the next 3 to 4 years, there's going to be a huge demand for housing, a huge demand as these millennials realize they want to buy. And many of them are realizing that now. Okay, projected state population growth. This is, we know there's growth. We know that there's buyers, but where are the people going? So this is from 2010 to 2020 from the census, and it's kind of showing the states that have really been growing fast. Of course, we know Texas and Florida top of the list, but you've also got South and North Carolina, you got Georgia, Arizona, Nevada, Utah, Colorado, Idaho. I mean, this is no surprise, right? We've been talking about this for a while. And over the next 10 years, the projected change, look at that. I mean, it still continues. Florida and Texas expecting to change 38, by 38%. And you've got, Washington, so Arizona, New Mexico, not maybe looking to grow as quickly, but, Colorado, wow, look at that. Utah, so just massive growth. Now the Midwest, not really known for growing really quickly, but steadily. So really important, again, chart to look at. Another thing we look at, U-Haul migration trends. This is just brand new. This came out, I think, last week. And basically what U-Haul does is looks at where the trucks are going, and you can kind of tell when it's expensive to get a truck, it means that there's more trucks going there, but then they've got all these trucks in that location. They got to send them back, so it's kind of cheap to take them out of that location. Anyway, they check these migration trends, and Tennessee was at the top of the list with Texas and Florida and Ohio, Arizona, Colorado. These were the places where people are going. And look at what's number 50 on the list, California. not a surprise, not a surprise, right? New Jersey, not a surprise, a high tax state. New York is on there, Connecticut. These are pretty high priced states with high taxes. And yet, you know, these other states that are the number one, they're more affordable. There's jobs going there, and taxes are low. Now, Atlas also does their migration, and I kind of look at it like U-Haul. Like, listen, you know, if you're a high net worth person, you're probably not hauling your stuff by yourself. You're not U-Hauling it. You're probably using van lines or something like that. So for maybe the higher priced homes, they're going to Idaho first, North Carolina, Maine, Alabama, and then outbound, the high net worth people, they're getting out to New York. We know that. New Jersey, you can see the list there. California is on there too. All right, so that's a little bit of a look at population growth and migration trends. Now let's look at jobs. Obviously, 2020 was a unique year. So many businesses that had been thriving were suddenly shut down overnight. Just a shocking year, right? A shocking year. So let's see where we are. I mean, look at this chart. This is amazing. In our lifetimes, we've never seen anything like that. Unemployment claims, you know, they kind of go up and down over the years. These lines that go, you know, these gray lines that go up and down, those are recessions. So you kind of always see unemployment claims go up during recessions and then flat, you know, go back down as jobs get better. But wow, like we've never seen anything like this, like we saw in 2020. But look at how it came down. So there were a massive amount of unemployment claims in the beginning, but it really started to taper off. So that's interesting, right? Cumulative job claims, we kind of comparing this to past recessions. These are past recessions where you lose jobs over time. Not this time. It was all at once. Bam. Unemployment rate. I'm using old charts because I think it's interesting to really look at history. And these are from the U.S. Bureau of Labor Statistics on the St. Louis Fed website. So you can just kind of see over the past, again, these lines are recessions. You know, you see people lose jobs during recessions and then things get better, and then you lose jobs during recessions, things get better. Well, wow, look at this. I mean, boom, just massive unemployment and then just massive recovery so quickly. It's just unprecedented. It's not where we were by any means. We had very, very, very historically low unemployment. And we're now at, you know, where we were maybe in 2014 and, you know, in the mid 90s. I mean, we've been here before. We have never been here before, you know, where we were in the early March, but we're not there anymore. And that's important to understand, is we're not there anymore. It is not March of 2020 anymore. We are January 2021. Things are moving in the right direction, and that is great news. Unemployment at 2014 levels. I mean, this is basically what I said earlier. The unemployment rate, it really was just terrifying for a while there, and then things started to recover as we started to understand this virus better, and as businesses started to figure out how to operate, you know, under these circumstances. Jobs started to come back, but, you know, technically right around 2014, 2015 levels. And it's not across the board job loss, it's by industry. So when we look at this, and Rick Sharga went over this slide as well, so definitely listen to that past webinar from December 30th to see what he has to say about this. But I think it's pretty common news that the hardest hit industry was this leisure and hospitality. A lot of industries, education not as affected, transportation and warehousing not as affected, mining, logging, not so much, construction, barely. So retail and trade, you know, surprisingly not as bad as we thought. So job loss numbers by industry, again, here it is. Leisure and hospitality just takes the cake every time. Financial activities barely hit. And that's why you're going to see some of the things that we're seeing. This is such an uneven job loss. It really hit the people in leisure and hospitality. So the cities that are very dependent on leisure and hospitality got hit the worst, while cities that have more dependence on financial activities or government headquarters type places, you know, they did better. So here's a list just to show you. I mean, it's no surprise Las Vegas is at the top of the list of cities that were hardest hit by the pandemic because, of course, Las Vegas is so dependent on tourism and conventions and people coming there. So just really still hurting. New York as well, and I'll explain that in the next slides. The East Bay, interesting, San Francisco. So really, San Francisco, East Bay is to me the same area. That's it. It got slot number 3 and 4, and that's interesting and concerning. Boston, Los Angeles, Detroit. I mean, these areas really got hit hard. I'm going to just show this slide. This is from Yardi Matrix. This is very interesting. Las Vegas versus New York. These are the two that were at the top of the list. Well, we're not surprised that Las Vegas was hit hard, right? 12.4% jobs lost. 57% of those jobs were in leisure and hospitality. So really, really hit hard. Now, what we're looking at Real Wealth is how is this going to play out over the next year? Is this going to be an interesting market to invest in the future? It's also important to note that it's pretty volatile. You know, Las Vegas got hit the hardest last time. So just again, important to understand it's very dependent on that industry. 12% jobs lost, 12.1% jobs lost in New York. And even though it's really a financial center and the financial industry really wasn't hit that hard, 42% of the jobs lost were in leisure and hospitality. So just a tremendous amount of people out of work in New York, and they're leaving. They just can't afford to live there. I mean, look at this. Have you ever seen New York look like that? Like maybe at 3 a.m., but not even at 3 a.m. It's usually still packed with people. So really, really hit hard. And of course, New York was the epicenter of the pandemic with so many people squished in one place. So they left, or that many left. But the note that was taken in Yardi Matrix was once the pandemic is under control, these places may recover very quickly. So that was an interesting comment. It's not like past recessions at all. Okay, so let's look at the least affected cities. We have, it's actually the bottom of the list is the least affected because I took this again from Yardi Matrix and I want to make sure to give them credit for their hard work there. Salt Lake City came in #1 least affected city in the nation. Amazing, amazing. So this is a city we're really looking at. How can we get in there? We kind of are already. We're building houses in the area. We haven't found a lot of rentals because it is more expensive there, but we're really taking a look at that. It's just a very solid place. Indianapolis came in second. This has been one of our markets at Real Wealth that we've been investing in and helping people buy rental property in for over 10 years now. Very stable market. During one of the worst, craziest years, recessions that we've seen in one year, Indianapolis was barely affected. Look at that, Dallas. Dallas is another city of course, I opened up with that city that I personally started investing in 2005, and it's kind of taken off ever since because of the massive job growth. Barely affected, 4%. Phoenix, Atlanta, another city that we've been helping people invest in for over 10 years. Just very, very solid, very solid. Look at Kansas City as well. Southwest Florida, Tampa's on there. Just, of course, Tampa felt it, but not that much. I mean, it's booming. St. Louis, Cincinnati, look at that, a stable market. It did very well during the last recession, did very well during this one. Fort Worth, Miami, Houston. So a lot of you, Chicago, look at that, Charlotte, Baltimore. These are all cities that you will see on Real Wealth Network's website as very, very good places to invest because of this. We're going to talk about why. So Salt Lake versus Indianapolis, these are the two least affected cities by the pandemic. In Salt Lake, only 2.6% of jobs were lost and 5,000 jobs were added in government, mining, logging, construction. So just a really solid market. Indianapolis, 3.9% jobs lost, 6.5%. Only 6.5% of those jobs were in leisure and hospitality. Indianapolis, a lot of people don't realize, is a big biotech city. So it just really was at the forefront of solutions to this pandemic and fared really well. So I did want to just mention this because I just want to show you how we kind of know some of this stuff when in advance. At Real Wealth, we have been syndicating, which basically means group investments or investors come together and pool money, and we invest it in different things, and specifically building. When you're building homes, it takes 5 years, to get through the project if you're lucky. And so you have to be able to forecast it. You have to. And we work with companies who specialize in that, like Myers Research and John Burns Real Estate Investing. So we had a project we syndicated in just outside of Salt Lake. It's about 15 minutes out on the way to Park City. It's in Park City. Many of you are in that development. These are the townhomes, and they sold out. Phase 1 is sold out, and we're just about to start phase 2. We're really, really happy. I got to tell you, in March, I was freaking out a little bit because I didn't know what was going to happen, but wow, the way things went, these all sold out, and we're about to build the single family homes. I'm telling you this partly because they're going to sell out, and I actually think it's very much a higher end. But if somebody's looking for a 1031 or a Airbnb, or just looking for a home for themselves, this project is phenomenal. And I'm not saying that just because we own it. I really, really mean it. Like, I want to buy one myself when the project is over because it's so well located that I just think it's a huge investment. We already have people, we have Airbnb managers in place if you're looking to do that, and we have rental management companies there if you're interested. It's very different. We're talking $1 million homes, but I think there's a huge upside for that. If you're interested, just reach out. You can reach out directly to me at Kathy@realwealth.com if you want more information. It's Kathy with a K at realwealth.com. All right, and so coming back to these cities that really did well, the business havens were already growing, and now they're accelerating through this. A lot of the trends that were already in place have just continued, have again accelerated. Dallas, it keeps coming up, but only 4% jobs lost, 1% financial jobs added. So this city is booming. I'm about to do a podcast right after this on some more huge companies that are leaving New York and California to go to other places, the business havens that welcome business. Atlanta, 4.5% jobs lost. It's just a solid market. So it just, again, it comes back to, it is not one housing market. It's a huge country with states that all have different rules and laws and tax laws, and they all behave differently, and we have to be really, aware of that. So looking at the GDP and just kind of, again, the big picture, you can see that the US GDP has just grown, over time. So even with this insane drop that we experienced in 2020, look at how it's come back. And also look at how, it's really only at 2018 levels. I mean, that's amazing to me, given what we've been through. I mean, the craziness of last year. So we just have a massive gross domestic product, a massive output, a massive economy. And just looking at it over a long haul, I mean, wow, look at what this country has done. So when you look at 2022, it's really just a blip, a big one, but it's coming back. And again, it's just back to those levels that we've just seen a few years ago. So we're bouncing back, and that's good news. Wages, this is kind of an interesting chart showing how wages have gone up, and kind of went up in 2020 and then kind of fell. I don't know if it's because lower paying jobs were not there, and so the average wage went up. I'm not really sure what that means, but overall wages going up. And again, I think this is just a repeat, but showing our GDP. Whoop, yep, that's a repeat. Okay, so why? What's going on? Kind of going back to the slide of wages going up and US GDP growth going up. What caused that? Starting in 71, right around the 70s, it just took off. And some people would say it's because in the 70s we were taken off the gold standard, and the Federal Reserve was basically, well, the dollar basically became the new gold standard. And that just really did a lot for the US. The US becoming the gold standard instead of gold. So you can kind of see, look at the takeoff, look at the wages. It really may have a lot to do with the Federal Reserve, which is why we need to pay a lot of attention to what the Federal Reserve does. And the Federal Reserve is basically our central bank. It's the country's largest banks that basically determine overnight lending rates and gauge the economy that way. So the Fed's prediction is that we'll have a faster decline in unemployment in 2021. And that sounds bad because the word decline is there, but it's good when you're talking unemployment. So basically, the Fed raised its forecast for economic growth to 4.2% from 4%, indicating caution, but positive. There's a belief that we're going to get through this as the vaccine is distributed and rolled out. And the Fed expects that by 2023, the jobless rate will fall back to that low unemployment rate we've had of 3.7%. So that's positive. If you've been feeling down in the dumps, remember the Fed really, when it controls the economy in a lot of ways because of the amount of money. It's like having your foot on the gas or the brake. That's what the Fed can do by creating more quote unquote gold. If the US dollar is the gold standard and the Fed has the ability to print more gold, so to speak, that you can do a lot with that. It's invested in the economy. And that's what if the Fed is saying we're projecting this, they're probably going to get what they want because they control that lever. So by 2023, the Fed expects, again, the jobless rate to fall back to 3.7% and return close to pre-pandemic levels. So that should hopefully make you feel better. Now, this might not make you feel better. So, like I said, back in the 70s, we were taken off the gold standard. And what that means is in the past, the amount of money you had to be tied to gold, basically with countries. Well, the US said, we don't just have enough gold for the amount of money we need, so we're just going to ditch that system. It was through the Nixon era. You can look that up. And make the dollar the gold standard, which somehow the world bought into that, and we could just kind of create it. And this is the money supply. This is the creation of more quote unquote gold, more money circulating. And we know that after the last recession, there was a lot of financial stimulus happening, the QE, the quantitative easing. And then it just kind of continued, more money in the, circulating. And boy, oh boy, look at what happened in 2020 when we're always talking about this fiscal stimulus and, hey, we want our $2,000 check and we want, these loans that are forgivable. It's all very understandable. I mean, we had a pandemic that shut everything down to keep people alive and, people couldn't work. So what are they supposed to do? How are they supposed to eat and pay their bills? So the fiscal stimulus, was needed, and yet there's a consequence. And that's what we're going to talk about today. So we had just massive money creation to pay for this. And how are we really going to pay for it? Because a lot of people think it's just free money. It's not. It's definitely not free money. So we know that back in March, the Fed came out once it was clear that we're going to have to shut down businesses to keep people alive. They said we're gonna do unlimited QE. That's quantitative easing. That's just another word for printing money. And we're going to set up new lending programs. So we're going to print money, give it to the banks. They're going to lend it to you. This is going to keep the economy going. And look at that. I mean, boom, just unprecedented money printing. When you look at this, the 3 months from February to May, like doubled. It's just, again, unprecedented. And with that, we got historically low interest rates. So, because the banks were able to, so the Fed lowered the overnight lending rates. Banks usually lend for 3% more than they borrow for. So if they're borrowing at near zero levels, they can give it to us for 3% or less. And that's what's happening. So we see historically low interest rates. It's unprecedented. What happens when we have low interest rates? People go shopping because based on history, this isn't going to happen again. This is a rare opportunity to lock in just historically low interest rates and low payments. Now, we thought we had it good back here, right? During the last recession, we thought we had low rates. I mean, look at that. Amazing. So that brings us to supply versus demand, all right? This is one of the most important things that we need to pay attention to when forecasting real estate. And so we've really got to understand what, causes supply issues and what causes demand issues. And so let's look at it. What affects demand? Well, we know, as I already talked about, job growth or job loss really affects demand. Demand, what is demand? It's like people wanting to buy stuff, right? So people that want to buy houses, they need to have jobs generally. They need to have good paying jobs to be able to buy a house. So if we're seeing job growth, we're probably going to see demand. And if we're seeing population growth or decline, we're going to either see people wanting to buy houses or not. If people are leaving an area like New York and San Francisco, you're going to see population, decline, and that's going to affect whether people want to buy or not, right? They don't want to buy if they're leaving. Affordability. This is a huge part of demand, affordability. So if people are just straddled with just massive debt, student loan debt, and car debt and other debt, credit card debt, that's going to affect their ability to buy a home and therefore affect demand. Interest rates, huge effect on affordability and therefore demand. And loan options. We know that in 2000, in the mid 2000s, I was a mortgage broker then. I saw what was happening. I just thought it was the craziest thing. What we had was lack of affordability. People couldn't buy homes. So guess what? We just made it really easy through the loan options. We did no money down loans. We did stated income loans. Just let's pretend we know you can't afford it, but let's pretend you can. Just write whatever you want on the loan application and bam, you get the house. We had negative amortization loans where, you know what, you can't afford it today, so we'll just pay part of the loan today and you could pay the rest later. It'll go on the end of your loan. Those were the neg am loans. And then there was the, oh gosh, there were other, it was crazy. It was a crazy time that made no sense. The teaser rate loans. So you would qualify for the loans based on a tiny teaser rate with the expectation that in 3 or 5 years you'll pay the real rate, but we're going to qualify you on the teaser rate, which makes no sense because that would assume that the person's going to make a bunch more money in 3 years, which is just not the case. So it's the loan options, or I should say the creative, stupid loans that can make things more affordable, but obviously in the mid 2000s that didn't work out because then it became unaffordable. People couldn't make their payments and they lost those homes, and of course that affected supply, which we're going to talk about in a bit. Price to rent ratios, so that can affect demand. If you're renting and suddenly find out that wow, you could own a home for cheaper than it costs to rent, that's going to really affect demand. Desirability. So, weather, activities, traffic, low taxes. We know that's what's a huge element to Florida and Texas is the low taxes, and that's really increasing desirability, which is the tax incentives. And then fear. This is an interesting one too. A lot of fear of living, near a lot of people. So it's driving people to the suburbs, and that's affecting demand in the suburbs. People want more space. They don't want to be around other people. They want a backyard. There were a lot of riots this summer, so that can affect demand. All right, so kind of coming back to some of the things I put on that list, interest rate really matters. It really matters, and that's why the Fed, as I said, has that lever. The gas lever is the one that says we're going to lower interest rates, make it more affordable, and it works. And when they want to slow things down, when they see a bubble, well, they raise interest rates and things become less affordable, less desirable, and people don't buy. And that's how they do it. So a 1% decrease in mortgage rate could mean you pay 10% less per month. So a purchase price might be $250. With a 4% interest rate, it's $1,431. With a 3% interest rate, it's $1,297. So a 9.4% savings. So what effectively you have is more people being able to afford, which often drives prices up, because if more people can afford and there's a limited supply, you're generally going to see prices go up. Now, if there was a ton of supply, then it wouldn't matter. Back in 2009, they lowered rates. There was nothing but supply. There were foreclosures everywhere, but there were so many, people without jobs and without ability. Even low interest rates did not help that situation. And back in the 80s, interest rates were really super high, but that didn't stop people, because even if they were 18% interest rates, people were buying houses because the houses were cheap enough and salaries were high enough that an 18% interest rate didn't stop people from buying. Isn't that amazing? But interest rate really does matter in a market where you're right at affordability levels. You drop the interest rate, people are able to afford more, and that especially is interesting when there's a limited supply, which is where we're at today, and that's driving prices up. So this is basically the Housing Affordability Index to show that prices can go up, but affordability goes down because of interest rate. And that's where we get a little confused in the news is you'll see, oh my gosh, look at this. Median priced existing single family home was $248. It went up, it went up, it went up, it went down, it went up, it went up. Woo, it's $317. And yet affordability, or the mortgage rate's 2.8, monthly payment, look at that, lower. It's about the same as when the house was $309,000. So prices can go up if interest rates are down and people can afford it. And that's obvious, but I just wanted to point it out that, that's where we're at. That's why prices are going up. So a loan availability matters. Like I said, if you want to buy one of those beautiful homes in Park City with a low interest rate today, but they don't have the loan for you, you're not going to buy it unless you have cash. Most people don't have $1 million cash sitting around to buy a house in Park City, so they're not going to. But if you did, if I could give you a loan for $1 million, and because interest rates are so low, the payment's $3,000 a month for that incredible $1 million house in Park City, and you could rent it out for more than that, hey, you might do it. So it's loan availability matters. And back in March, the credit markets just seized up completely. There were not loans available. Jumbo loans disappeared. There was a lot of fear about investing, or lenders investing in larger homes. So those products just disappeared, and we started to see more inventory in the high-priced markets because there simply weren't the loans. Well, Mortgage Standards, this is an article that just came out. I think it was in August or so. Nope, it was before that. Anyway, that mortgage credit, no, it was November. Mortgage credit standards loosened for the first time since July. So this author basically interviewed people and saw that the credit availability for low credit score and higher LTVs increased in October. Also, jumbo loans increased, and there was a drop in supply of around 60% at the beginning of the pandemic, but it rebounded. So we were seeing more jumbo loans, and then this final paragraph here, there was an increase in adjustable rate mortgages as well. So that's what we're seeing. I wouldn't be concerned about it being too loose by any means. It's just loosening up, which means that some of these loans are coming back. Lenders are feeling more confident. They're going to do these jumbos. They're going to do these ARMs. They're going to do higher LTVs. Lower credit scores, because they believe in the housing market. And that's, that's just interesting to pay attention to. I don't think it will ever get to the crazy, stupid lending that we had in the mid 2000s, but it's definitely loosening up, and that could be a good thing. Remember I said that with demand, you've got to pay attention to debt, and our people just totally over leveraged. And so we see here that actually consumer credit has dropped for the first time in 8 years. Amazing. People kind of stopped using their credit cards and started saving. The consumer savings rate went way up. People just were like, okay, we're not spending, we're saving, we're staying home, we're not traveling, we're not eating out, we're going to make beans for dinner, and saved money and probably paid off some of those credit cards, and now they're starting to spend again. Existing home sales, here it is, just picked up, dropped, and then picked up. We talked about back then, this is since the 70s too. So we talked about in March, is this going to be a V or a W or an L-shaped recovery? It is beyond V. I don't even know what you call that letter, but it really picked up along with home prices. We see that in 2020. Who would have thought in March that we would see this? But because of the Fed stimulus, because of the access to loans and low interest rates and the lack of supply, we saw home prices go up this year. So let's get on to supply. Where are we? Well, I just did a quick Google search on housing supply, and this is what came up. It's across the country. There is really not any place that seems to be having an abundance of inventory, except maybe San Francisco and New York and parts of LA. But look at that, Dallas Morning News. U.S. home sales listings at record low. The Denver Post, Metro Denver housing market navigates pandemic to a record-setting year. Again, historically low inventory. Cincinnati, one of the hottest housing markets in the U.S. with a shortage of inventory. Chicago homes for sale at lowest inventory in at least 13 years. U.S. mortgage rates dropped to record low again. A low inventory of homes to buy combined with surging demand has driven up prices. U.S. home prices spike 8%. Availability of for-sale homes has dwindled. So why? Well, we know coming into this, we already had not enough inventory, but we are at record low inventory. This is the year-over-year change, months of supply. Look at that, months of supply, just record low. So what affects it? Why are we so low on supply? Well, what affects supply is new inventory, right? If you have a certain amount of supply and some of it's getting old and not maybe being sold, and you're not building new inventory, then that'll affect it. Cost to build, low profit. If costs are up and the profit's low, then you're not going to see new inventory. Regulations, we're going to stop builders from building. Available land and resources. That's the problem with New York and San Francisco, is they're surrounded by water, don't have enough land. Natural disasters, fires, floods, tornadoes, that can affect supply. Like in California, so many homes missing from fires, and Houston from floods. So that increases demand. And then just demand. So obviously if interest rates go up, or if people default, they can't afford their mortgages, then you would start to see an increase in supply. But one of the main reasons we went into 2020 with low supply already was this chart, the slow pace of new construction over the past decade. We know that in the mid 2000s, when loans were too easy to get, and construction loans were too easy to get, a builder could say, I want to build a house, get a construction loan, pay himself a ton of money from that construction loan, and probably sell the house or not, didn't matter, they already got paid. So a lot of builders built, there was too much inventory, and then of course the housing market collapsed as people couldn't pay those loans, and builders just stopped building. They couldn't compete with existing homes and foreclosures, short sales and everything. So builders just came to a complete stop and stayed there for a while. Super low construction, because all, in 2010, 11, and 12, there were still tons of foreclosures, and that's what people were buying. They weren't buying new homes. So a lot of new homes weren't being built, and a lot of builders were wiped out anyway. But then it started up, land was cheap, builders started building, the home prices started to go up because foreclosures were getting sold, and then prices came back to normal. But even now, we're still not really even close. We're like not even halfway where we were in 2005 in terms of new construction. So it's just been at a very low pace. builders have had all those things I talked about, rising costs, rising permit fees, regulations, and it's just, been hard to bring on new inventory, especially affordable inventory. And now today we have a serious shortage of lots even to buy if you wanted to build. So when you look at here, look at these different places, San Diego, barely any lots, Seattle negative, Nashville negative, Baltimore negative. I mean, it's just not lots. They're just not available. Salt Lake City has some. All right. New home inventory is low as a result. So if there's not construction, there's not new home inventory. And so short supply, the construction is up. So the housing outlook from Fannie Mae is that we'll see housing starts, kind of up in 2021 to 1.4 million, and 2022 to 1.5 million. 1.5 million is probably where we need to be with our growing population. So by 2022, we'll at least be kind of where we need to be, but we'll still be behind. So we've got a few years ahead of us of this problem of lack of supply and huge demand. And again, Fannie Mae sees new family home sales up from 830 to 881, and then kind of flattening out in 2022. Existing home sales kind of remaining right around about 5.5 million. And there you go. Mortgage rates are on there. Yeah, the mortgage rates, they actually see staying low. So that tells you something, right? That tells you that we're probably going to see continued demand. All right, and the future foreclosure crisis. I know we're at an hour and I'm really trying to hurry. I just had a lot of slides and a lot I wanted to share. So future foreclosures, I already went over this in the last webinar, but we saw a lot of headline news on, oh my gosh, all these serious delinquencies. Well, they're delinquencies because they're forbearances, but that doesn't mean they're going to end up as foreclosures. You can watch the Rick Shargay interview and webinar. We had 2.3, almost 2.4 million of those forbearances extended. They'll probably turn into loan modifications. 2.3 were just removed because they're performing. 500,000 just paid off their mortgage, which means they sold them probably or refied, and then expired. So they're just in loss mitigation, and then 80,000 delinquent. So we will see an uptick in foreclosures, but probably not until next summer or the end of next year because of the government programs in place to prevent foreclosures. Excuse me. So so again, super V-shaped recovery in housing. Not even a V-shaped, whatever that is, it's big. What about commercial real estate? Well, we've been saying for a while, obviously office, cap rates are increasing. When cap rates increase, that basically means that it's not good for values. So we're obviously office is getting hit. But multifamily, look at that. It's not just single family that's affected here. Multifamily actually is seeing cap rates decline. So that was a little bit of a surprise to me. That means they're getting more valuable. Fannie Mae forecast for the GDP. This is, again, if you're worried that we were going to just go into a massive recession, Fannie Mae doesn't think so. This is a 3.3% growth in 2021, not massive growth, but certainly not bad, better than 2019. And 2022 also. Unemployment, slowly improving over time. Inflation, this is the big one, inflation increasing. And of course, that is to be expected, which we're going to talk about in a minute, which is the economic risk. The biggest risk we have, like I said, there's a price to pay for stimulus for all this money being printed. Excuse me, I just need a glass of water. As we've created more debt, we haven't really created more output. So it's the debt to income, basically. Our debt has gone up dramatically in 2020. It was already bad going into this. It's real bad now. So what now? what's going to happen. Some say that stagflation is next because all that money hasn't really created, incredible economic output. It'll be steady and it'll be okay, but it's not like going to be mind blowing considering the amount of debt we took on. So what you get generally when you print that much money, historically, I showed you the money supply going up was in direct alignment with prices going up. So we'll probably see asset levels go up, continue to rise, but wages not really going up. So the sad news to this is that while everybody wants their $2,000 stimulus check, and they should, they've been out of work, they're going to pay for it later in inflation with prices going up. Things are going to cost more, specifically real estate, rents, and it's going to get harder, that divide between the wealthy and those who are paying more for rent every year and spending more on housing. That is going to get worse. So that is why we are on a mission at Real Wealth. We just had our 2-day annual retreat with our leaders at Real Wealth, and we're like, let's get so clear on our mission and share it, that our mission is to help people create real wealth. And what we mean by that, of course, it's real estate, of course, but it's real wealth is having the time and the money to live life on your terms. So you're not stuck trying to make ends meet and make payments on housing you can't afford. And no, instead, you're on the side of the divide that is going up with inflation because you own the assets that are inflating. That is our mission, to help as many people as we can acquire those assets, those cash flowing real estate deals and growing markets through our turnkey model, so that you're on the side of real wealth, that you have the time and the money to live life on your own terms. That's why we're here. That's why we're educating you. It is our passion. We just looked at our numbers. We had 176 people last year buy their first investment property. That's huge. That's what we live for. We had a whole bunch of people buy their second and third and build their portfolio, but we got 176 people to do it for the first time. And that's through the help of our investment counselors and our teams, our property teams across the country that search high and low for inventory that's hard to find. They fix it up, they get it rented, they have property management in place to help meet this goal. And I'm telling you, it's a place of passion. We care. We want to know that in 10 years, you have your properties you got into the market. For one, you got in, you locked in these record low rates, and you own assets that are inflating. So what's next? If you haven't joined the network, well, you probably have because you're here, but if you just want to know more, you of course join Real Wealth Network and you go to the Learn tab. We have so many topics here that are important to understand. You've got to understand this 1031 exchange, and we're going to be talking about it in the next few weeks. A lot of these tax benefits could be changing, so you probably want to take advantage of it now while you can if you're thinking about it. Selling high-priced, low cash flow properties and exchanging them for low-priced, high cash flow in emerging markets. Bookkeeping, financing options, news, opportunities, all kinds of things. Self-directed IRAs, asset management should be on there. I don't know, I'm sure it's on there somewhere. Yeah, asset protection. These are super, super important. So go through these, learn it, be an expert. Again, join Real Wealth, enjoy those webinars, podcasts, free education. Get my book, Retire Rich with Rentals. I wrote this specifically because I didn't want people to make mistakes. I want you to really know what you need to look for when buying property, because you got to buy the right one so that it works out. You can download our property investing checklist from our website. Once you've really got that information, you can get pre-approved with one of the lenders that we recommend. That will tell you what you can buy, and if you can't buy yet, what you need to do to get there. And then speak with one of our investment counselors. It's free. They're ready to speak with you and help you. Every single one of our investment counselors is an investor themselves. That's the requirement. They're amazing. You could speak with them and they'll help you with your plan. Okay, and so here you'll see on the Invest tab on our website, There's all these investor resources, the lenders. It's really important that you get the right lender because a lot of lenders don't understand investment property in Dallas, for example. So you want to talk to the right lenders. Non-conventional, if you already maxed out on the loans, you can get 10 conventional loans through Fannie and Freddie. Once you've maxed out on that, you need to go into the non-conventional. So we've got those lenders. Again, referrals to self-directed IRA companies so that you can buy real estate with your IRA, and 1031 facilitators, really good CPAs that understand how you can take write-offs that will really reduce, increase your cash flow by reducing your taxes, asset protection, all that. You can get those resources here. You can also go on and find out more data on these different markets that we really think obviously have done well through past recessions and we think are continue to grow based on demographics and job growth and lack of housing. You can get all those details on our website under the Invest tab. And when you're there, you'll get a referral to teams that we've worked with in those areas who can help you find those properties. They have their renovation teams out there so they can get the properties in rent-ready condition that meet our standards. And then they have property management in place, and you can get referrals right there.